What if I told you the most powerful investment lessons Warren Buffett ever learned didn't come from billion-dollar deals but from moments of extreme pressure, personal struggle, and brutal self-honesty? The middle sections of The Snowball Parts 4, V and V I don't just tell the story of how Buffett built Berkshire Hathaway. They reveal how he sharpened his strategy, shaped his legacy, and survived one of the biggest corporate scandals in Wall Street history. And here's the twist. The Warren Buffett we all admire today didn't fully emerge until these chapters. This is where the quiet investor from Omaha becomes the oracle, the crisis manager, the business statesman, and beneath all of that a human being grappling with loss, vulnerability, and the weight of unimaginable responsibility. In Part 4, we watch Warren execute one of the most important pivots in financial history. He stops thinking like a bargain hunter and starts thinking like an owner. An owner of world-class businesses with pricing power, brand loyalty, and unbeatable economics. This is when Berkshire stops being a textile mill and becomes a compounding machine. You'll see how Buffett builds relationships with CEOs like Katharine Graham and Tom Murphy, why See's Candies changed his entire approach to valuation, and how insurance float turns into his ultimate superpower. Then Part 5 flips the entire narrative. Buffett goes from compounding capital to fighting for survival, not his own, but Salomon Brothers. This is the moment he steps into one of the worst scandals in financial history, walks into Congress, and saves a Wall Street giant with nothing but honesty, credibility, and discipline. Buffett wasn't a bond trader. He wasn't a regulator. He wasn't even seeking control. But when the crisis hit, he was the only adult in the room and the world saw it. And just when you think the story can't get any bigger, Part 6 brings everything closer to home. Berkshire becomes a global powerhouse. Warren becomes one of the most respected voices in capitalism. And yet his private life hits its most painful chapter. Susie Buffett, his emotional anchor for decades, faces declining health. Warren, despite his billions and influence, struggles with something money can't fix. This tension between public success and private vulnerability is what makes these sections the most powerful. Because here's the truth. Warren Buffett didn't become Warren Buffett just by reading balance sheets. He became Warren Buffett by navigating chaos with integrity, by adapting his strategy when the world changed, and by admitting when he failed even when the price tag was in the billions. So before we break down Parts 4, V and VI, ask yourself, do you want to know how the world's greatest investor actually thinks under pressure? Do you want the real blueprint, not the quotes, not the memes, but the mindset that built a financial empire? Then keep watching, because this is the part of Buffett's life where the snowball doesn't just roll, it explodes into the legend we know today. Chapter 30 marks the beginning of a major transition in Warren Buffett's personal and professional life as he moves from the intense, work-driven years of running his partnerships into a more complex phase. That includes family dynamics, community expectations, and growing public visibility. This chapter focuses heavily on Warren's marriage to Susie and how their relationship evolves. As his career accelerates, the chapter explains that Warren's increasing workload and single-minded focus on investing began creating imbalance at home. Susie, who played a central role in providing emotional stability, companionship, and social structure, gradually found herself carrying a disproportionate share of the family responsibilities, while Warren remained deeply attached to her. His dedication to work limited his ability to participate consistently in family life. Chapter 30 highlights how Susie's empathy and patience helped maintain stability, even as Warren's commitments expanded. Another important theme is Susie's personal growth. As Warren became more financially successful, Susie developed her own interests, particularly in community work, music, and social causes. The chapter emphasizes that her increasing independence was not rooted in conflict, but in her need to build an identity outside Warren's career. This shift affected their marriage, eventually leading to a relationship structure that, while unconventional, remained grounded in mutual respect and emotional support. Professionally, Chapter 30 illustrates how Warren's rising reputation created new social obligations, invitations, public attention, and community expectations increased. However, Warren remained introverted and preferred to operate privately, which often left Susie to handle the social aspects of their public life. Her efforts significantly shaped the Buffett family's community presence. Overall, Chapter 34 captures the intersection of Warren's growing business success and the evolving dynamics of his marriage. It shows how personal relationships and emotional support systems played a critical role in sustaining Warren during the transformative years of his investing career. Chapter 35 continues exploring the evolving personal dynamics in Warren Buffett's life, especially the shifting structure of his marriage to Susie, as both partners grow in different directions. By this point in the story, Warren's financial success is accelerating, but his personal life is becoming more complicated. The chapter highlights how the demands of Warren's work and his introverted nature increasingly contrast with Susie's expanding social world and emotional needs. A key theme in Chapter 35 is Susie's move toward independence. She becomes more active in Omaha's social and charitable circles, taking on leadership roles, building friendships, and developing her own identity outside the home. Her community involvement grows in part because Warren is largely absent, due to his intense focus on investing, research, and partnership management. The chapter shows that Susie is not leaving Warren emotionally. Instead, she is seeking fulfillment in areas where Warren cannot participate. The chapter also introduces the early stages of Susie's physical separation from the household. While they remain committed to each other, Susie increasingly feels that Warren's emotional needs and dependence on her are overwhelming. She believes that giving him space and reducing her immediate presence might ultimately support his personal growth. This decision becomes an important transition in their marriage and lays the groundwork for the later, more unconventional structure of the Buffett family. Meanwhile, Warren remains deeply attached to Susie and struggles with the idea of change. Chapter 35 emphasizes that his emotional dependence on her is significant. Despite his success in business, Warren continues to rely on Susie for stability, social navigation, and personal grounding. Overall, Chapter 35 illustrates the widening gap between Warren's internal world dominated by work, analysis, and routine and Susie's growing desire for independence and self-development. It is a turning point in their relationship, showing how personal evolution and emotional complexity intersect with Warren's rising career. Chapter 36 examines the period in Warren and Susie Buffett's marriage, when their relationship shifts from a traditional partnership into a more unconventional structure. This chapter highlights the emotional, social, and practical factors that lead to Susie's decision to live independently while remaining connected to Warren. It illustrates the contrast between Warren's increasing public reputation and his persistent personal dependence on Susie. The chapter explains that, as Susie's personal interests expanded, particularly her involvement in social activism, community work, and musical pursuits, she felt compelled to build a life beyond the intense responsibilities of supporting Warren. His introversion, irregular routines, and narrow focus on investing made him heavily reliant on her for emotional stability and social functioning. Over time, Susie recognized that fulfilling this constant role limited her ability to grow individually. Chapter 36 shows that Susie's decision to create physical distance was not rooted in conflict or a desire to end the marriage. Instead, she believed Warren needed to develop greater personal independence, especially in areas such as managing household responsibilities, navigating social environments, and forming relationships outside their marriage. Susie viewed this shift as supportive rather than disruptive, even though the transition required difficult adjustments. The chapter also highlights how Warren responded. Professionally, his career remained strong, but personally, he struggled with the change. He missed Susie's presence, stability, and emotional oversight. Despite these difficulties, he respected her need for autonomy and accepted the evolving structure of their relationship. This period eventually opened the door for new people to enter Warren's personal life, shaping his daily routines while maintaining Susie's central role in his emotional foundation. Overall, Chapter 36 illustrates a pivotal moment in Warren's private life, showing how personal evolution, especially Susie's growth, interacted with Warren's increasing professional success. It underscores the complexity behind the Buffett family dynamic, which continued to function even as its form changed significantly. Chapter 37 focuses on the introduction of Astrid Manx into Warren Buffett's life, and how her presence begins reshaping the day-to-day dynamics of the Buffett household. This chapter emphasizes the practical realities of Warren's personal needs, Susie's physical absence, and the emerging structure that would define the Buffett family for decades. The chapter explains that after Susie moved out to pursue her own life and independence, Warren struggled to manage basic household and emotional needs. His work-centric lifestyle, limited social skills, and dependence on routine made it difficult for him to function without support. Susie, aware of this, did not want Warren to be alone or overwhelmed. Through her involvement in Omaha's social community and volunteer work, she introduced Warren to people who could provide companionship and practical assistance. This is where Astrid Manx enters the narrative, a local waitress who knew Susie through charity circles. Astrid gradually becomes part of Warren's daily life. The chapter stresses that her role began with practical help managing meals, household tasks, and providing companionship in a calm, consistent manner. Over time, she and Warren developed a close, stable relationship that complemented Susie's ongoing emotional presence in his life. Chapter 37 also emphasizes that this arrangement was not based on secrecy or conflict. Susie and Astrid maintained a cooperative and respectful understanding, each fulfilling different roles in Warren's life. Susie remained the emotional anchor and public partner, while Astrid became a daily source of support and routine stability. Professionally, Warren continued operating at a high level, but the chapter illustrates how personal support systems were essential to maintaining his productivity. The stability provided by both women allowed Warren to sustain his intense focus on investing without disruption. Overall, Chapter 37 highlights the emergence of a non-traditional family structure built around practicality, emotional understanding, and mutual respect. It reveals an important layer of Warren's personal life that coexisted with and supported his expanding professional success. Chapter 38 focuses on the closing of Warren Buffett's investment partnerships in 1969 and the major strategic pivot that followed. This chapter marks one of the most important decision points in Warren's professional life, driven by a combination of market conditions, investment discipline, and his evolving view of opportunity. By the late 1960s, the U.S. stock market was experiencing excessive speculation, especially in fast-growing glamour stocks. Valuations were stretched far beyond intrinsic value, making it increasingly difficult for Warren to find investments that met his safety and return standards. Rather than compromise his principles, Warren concluded that continuing to manage outside capital under these market conditions would risk partner money and violate the disciplined approach he had always promised. Chapter 38 explains that Warren sent a letter to his partners announcing his decision to wind down the partnerships. His message was clear: the environment no longer supported the kind of value-driven strategy he believed in. He emphasized that he did not know when conditions would change, and therefore preferred to return capital rather than pursue investments he considered inferior or speculative. Importantly, Warren offered partners the option to retain their shares in Berkshire Hathaway, which the partnerships already controlled. Berkshire, though still a weak textile business, provided a corporate shell and investment vehicle through which Warren could continue deploying capital independently. This move effectively transitioned his investing activity from partnerships to a corporate framework, laying the groundwork for the future Berkshire Hathaway conglomerate. Chapter 38 also reinforces Warren's commitment to transparency and responsibility. He refused to lower his standards, even though closing the partnerships meant giving up a lucrative management structure. This decision underscores his long-term orientation and unwillingness to chase returns during overheated markets. Overall, Chapter 38 marks the end of Warren's partnership era and the beginning of Berkshire Hathaway as his primary investment platform. Chapter 39 examines Warren Buffett's transition from running investment partnerships to managing Berkshire Hathaway as his primary investment vehicle. After the partnerships were wound down, with outside capital returned and the speculative market environment still unfavorable. Warren shifted his full focus to Berkshire, which now served as both a corporate shell and a long-term capital allocation platform. The chapter explains that Warren entered this new phase with a large portion of his personal net worth invested in Berkshire. This alignment reinforced his discipline. He would now operate with his own capital at risk rather than partner money. Berkshire, though originally a declining textile business, offered Warren the freedom to make investments without the structural constraints of partnership agreements or the pressure of quarterly comparisons. A key theme in Chapter 39 is Warren's increasing emphasis on controlled businesses and wholly owned subsidiaries. While he still bought marketable securities when attractive, Warren began looking for entire companies he could purchase outright. He believed that controlling businesses provided more reliable long-term compounding opportunities, allowed him to guide capital allocation internally, and reduce dependence on public market cycles. Chapter 39 highlights Warren's investment in National Indemnity, an insurance company that would become a cornerstone of Berkshire's model. Insurance operations generated float capital held temporarily before claims were paid, which Warren could invest. This investment represented a strategic breakthrough. The combination of underwriting discipline and investable float created leverage that could fuel Berkshire's long-term returns. The chapter also addresses Warren's continued caution. Following the market speculation of the late 1960s, he maintained a conservative posture, avoided overpriced growth stocks, and focused on businesses with stable economics and trustworthy management. His approach reflected an expanded version of Graham's principles, still value-oriented, but increasingly focused on quality and long-term competitive advantages. Overall, Chapter 39 marks the beginning of Berkshire Hathaway's transformation into a diversified investment and operating company, driven by Warren's disciplined capital allocation and growing focus on business ownership. Chapter 40 focuses on the early development of Berkshire Hathaway as a diversified enterprise and highlights the increasing strategic importance of insurance within Warren Buffett's long-term investment model. After acquiring National Indemnity, Warren now had access to insurance float capital generated from premiums that could be invested before claims were paid. This chapter details how float became one of the most powerful tools in Warren's investment strategy. The chapter explains that Warren recognized float as a form of low-cost, sometimes even negative cost leverage. Unlike traditional debt, insurance float did not require fixed interest payments. It was generated naturally through underwriting activity. If the insurance business was run conservatively and produced underwriting profits, or at least minimal losses, the float effectively provided Berkshire with a steady stream of investable capital. This allowed Warren to compound returns at a scale unavailable through partnerships alone. Chapter 40 also examines Warren's close working relationship with Jack Ringwald, founder of National Indemnity. Ringwald was disciplined, cautious, and understood the importance of conservative underwriting. Warren appreciated Ringwald's independence and allowed him to operate without interference, reinforcing Warren's broader philosophy: buy capable businesses and trust strong managers. This reinforced Berkshire's emerging decentralized operating model. The chapter describes how Berkshire's capital allocation approach began to solidify. During this period, Warren used the float to purchase marketable securities that met his criteria for price, value, and long-term potential. He avoided speculative investments, remained cautious about market trends, and continued applying Graham's margin of safety principles while expanding into higher quality businesses. Another important point in Chapter 40 is Warren's increasing reputation in Omaha and the broader business community. His early success with Berkshire and disciplined investment track record strengthened his identity as a rational, long-term thinker. Chapter 40 marks a foundational stage in Berkshire's transformation, defining float as a central engine for compounding and reinforcing Warren's emerging model of combining conservative operations with opportunistic investing. Chapter 41 highlights Warren Buffett's growing influence as both an investor and a public figure. During the early 1970s, this chapter focuses on how Warren's disciplined investment philosophy positioned him to take advantage of broad market declines. While many investors were experiencing significant losses and emotional stress, it marks the beginning of Warren's emergence as a national voice on business and finance. Long before Berkshire Hathaway became a household name, the chapter explains that the U.S. economy entered a difficult period of inflation, higher interest rates, and market stagnation. Many companies that had been priced at speculative levels in the 1960s began to fall sharply. Because Warren avoided overpriced growth stocks and maintained a high standard for intrinsic value, Berkshire was well positioned to deploy capital at attractive prices. Warren purchased strong companies at depressed valuations, including media, advertising, and insurance-related businesses. Another key point in Chapter 41 is Warren's increasing visibility due to public speaking and media interactions. Although naturally introverted, Warren began addressing business groups, universities, and civic organizations. His communication style, plain-spoken, logical, and grounded in long-term thinking, stood out in a period filled with economic uncertainty. These appearances contributed to the early development of Warren's reputation as a rational and trustworthy voice on investing. The chapter also highlights Warren's growing network of business relationships. Many CEOs and managers he admired began to view him as a potential long-term partner or owner. His reputation for fairness, patience, and non-interference in operations made him an attractive acquirer for businesses seeking stability. Finally, Chapter 41 reinforces Warren's commitment to discipline. Even as market opportunities expanded, he continued to avoid speculation, maintain large cash reserves when necessary, and insist on a clear margin of safety. Overall, Chapter 41 marks an important shift. Warren evolves from a regional investor into a widely respected national figure while strengthening Berkshire's foundation with disciplined, opportunistic capital allocation. Chapter 42 focuses on Warren Buffett's increasing involvement in the newspaper and media industry during the early 1970s, culminating in one of his most influential early investments, the purchase of the Washington Post Company stake. This chapter highlights Warren's shift toward acquiring high-quality businesses with durable competitive advantages and evolution from pure deep value investing toward a more qualitative, long-term ownership approach. The chapter explains that Warren had long admired newspapers because of their strong local monopolies, predictable cash flows, and critical role in public life. He recognized that major metropolitan newspapers possessed significant pricing power and high barriers to entry. This structural advantage allowed them to sustain strong profitability, even during challenging economic periods. A pivotal moment in this chapter is Warren's meeting with Katharine Graham, the publisher and leader of the Washington Post Company. Warren quickly recognized her integrity, intelligence, and commitment to the company's long-term mission. He admired her leadership during difficult periods, including political pressures and financial uncertainty. After reviewing the company's financials and competitive position, Warren determined that the stock was deeply undervalued relative to its intrinsic value. Warren invested approximately $10 million, an unusually large commitment for Berkshire at the time. The chapter emphasizes that this decision reflected Warren's growing confidence in owning high-quality businesses, not just cheap ones. It also marked the beginning of a long-term professional and personal relationship between Warren and Katharine Graham, who later credited him with helping her develop confidence in business decision-making. Chapter 42 further highlights Warren's emphasis on rational analysis during a period when many investors were fearful. The market was turbulent, but Warren maintained his discipline, focusing on durable economics and trustworthy management. Overall, Chapter 42 marks a key milestone in Warren's shift toward long-term ownership of exceptional businesses. His investment in the Washington Post Company became one of the most successful and defining decisions of his career. Chapter 43 focuses on the period when Warren Buffett's public profile begins to rise significantly. As Berkshire Hathaway's investments expand and his disciplined strategy continues, delivering strong results, the chapter highlights that by the mid-1970s, Warren was no longer just a successful investor operating quietly out of Omaha. He was becoming a well-recognized voice in American finance. attracting growing attention from business leaders, journalists, and investors. A key theme in this chapter is Warren's increasing involvement with high-quality media companies, particularly due to his investment in the Washington Post Company. His strong relationship with Katharine Graham positioned him as not only an investor, but also a trusted advisor. As the company navigated regulatory, political, and competitive pressures, Warren provided analytical clarity on valuation, capital allocation, and long-term strategy. His influence strengthened Graham's confidence and helped shape the company's financial direction. Chapter 43 also explores how Warren's national visibility expanded. As he began participating in more public conversations about corporate governance, market behavior, and rational investing, business groups sought his input, and journalists recognized that Warren offered clear, logical perspectives in a period marked by economic uncertainty and inflation. Even though Warren remained introverted, he understood that effective communication was becoming part of his broader role as a business leader. Professionally, Warren continued applying disciplined investment principles. He avoided overvalued growth stocks, maintained a strong cash position when necessary, and focused on businesses with sustainable economics. Berkshire's portfolio increasingly reflected a blend of insurance operations, high-quality public equities, and a growing number of controlled or wholly owned subsidiaries. The chapter also notes the continued evolution of Warren's reputation among managers of companies he invested in. His long-term perspective, hands-off operational approach, and emphasis on honest management made him a highly desirable shareholder. Overall, Chapter 43 captures Warren's transition into a prominent figure in American business, balancing expanding public influence with unwavering investment discipline. Chapter 44 focuses on Warren Buffett's growing involvement with major American corporations and his emergence as a trusted, influential figure among CEOs. This chapter highlights how Warren's disciplined investment principles and credibility earned him access to business leaders who sought his perspective on capital allocation, long-term strategy, and market behavior. A central theme in Chapter 44 is Warren's relationship with Tom Murphy, the CEO of Capital Cities Communications and later one of Warren's closest business confidants. Warren regarded Murphy as one of the finest managers he had ever observed, highly rational, extremely efficient, and skilled at both operations and leadership. The chapter emphasizes that Warren's admiration for Murphy played an important role in forming his views on what exceptional management looks like. This relationship laid groundwork for future business collaborations between Berkshire Hathaway and Capital Cities. The chapter also highlights Warren's deepening interest in media and broadcasting businesses, which he viewed as having strong competitive advantages due to limited competition and powerful local market positions. Warren considered advertising-driven media models to be durable and financially predictable, characteristics that suited his evolving preference for high-quality, cash-generative companies. Another key point is the expansion of Warren's influence beyond investing. CEOs and business leaders increasingly sought him out for advice, not because he tried to impose himself, but because his analytical frameworks were clear, logical, and rooted in long-term thinking rather than short-term market trends. This period marked the beginning of Warren's role as an informal advisor to executives, navigating complex business decisions. Chapter 44 also reinforces Warren's continued discipline in Berkshire's investment strategy. Even as his network expanded and high-quality opportunities appeared, he maintained strict standards for valuation, management quality, and long-term economics. Chapter 44 captures Warren's growing integration into elite circles of American business leadership and shows how his relationships with exceptional managers further shaped his investment philosophy. Chapter 45 examines the period when Warren Buffett's investment discipline and growing reputation intersect with significant changes in Berkshire Hathaway's structure, strategy, and financial capabilities. This chapter highlights how Warren continues strengthening Berkshire's foundation by reinvesting insurance float, acquiring high-quality assets, and refining his long-term approach to capital allocation. A core theme in Chapter 45 is Warren's increasing confidence in the insurance model. as the engine driving Berkshire's compounding. With National Indemnity performing well and float expanding, Warren had a consistent stream of investable capital. He emphasized conservative underwriting and disciplined reserves, ensuring that Berkshire's float acted as a low-cost funding source rather than a financial liability. This structure allowed him to scale Berkshire's investments without depending on traditional debt or external capital. The chapter also describes Warren's continued search for exceptional businesses run by outstanding managers. During this period, he deepened relationships with leaders he admired such as Tom Murphy and Katharine Graham, and looked for opportunities where Berkshire could take meaningful stakes in durable, competitively advantaged companies. Warren increasingly viewed talented management as a critical component of long-term business value. Another important point in Chapter 45 is Warren's approach during periods of economic challenge. Inflation and market volatility were creating pressures across U.S. industries, but Warren maintained a disciplined posture. He refused to chase high-growth companies priced at unrealistic multiples, and continued focusing on businesses with stable cash flows and strong intrinsic value. His long-term view offered a clear contrast to the short-term behaviors common among many investors at the time. The chapter also reinforces Warren's communication style with Berkshire shareholders. His explanations of float, capital allocation, and business performance remain straightforward and principle-based, building the foundation for what would later be recognized as one of the most transparent shareholder communications in corporate America. Overall, Chapter 45 captures Warren's strategic consolidation of Berkshire's strengths: insurance leverage, disciplined investing, and high-quality management, setting the stage for its transformation into a major American conglomerate. Chapter 46 centers on Warren Buffett's role during the 1970s as both an investor and an emerging public figure, particularly through his increasing involvement with major media companies and his visibility as a respected business advisor. This chapter highlights the environment of the time: economic uncertainty, volatile markets, and shifting regulatory pressures, and how Warren's disciplined, value-driven approach positioned him differently from many investors. A central focus of Chapter 46 is Warren's deepening connection to the Washington Post Company, especially as it faced external pressure from the Federal Communications Commission and evolving industry dynamics. Warren served not only as a major shareholder, but also as a trusted advisor to Katharine Graham. He provided guidance on valuation, strategy, and capital allocation, reinforcing his role as a stabilizing force during a period of industry transition. This involvement further cemented Warren's reputation as someone who could evaluate businesses clearly even in turbulent conditions. The chapter also emphasizes Warren's growing public identity. He was increasingly invited to speak to business groups, universities, and professional organizations. His lectures and discussions demonstrated a consistent message: focus on intrinsic value, avoid speculation, and make decisions using rational, long-term principles. These appearances strengthened his influence outside of Berkshire and helped shape his reputation as an informal educator of financial discipline. On the investment side, Warren continued to deploy Berkshire's capital cautiously. He remained skeptical of market sentiment, avoided highly priced growth stocks, and focused on businesses with reliable earnings and strong internal economics. Insurance float was expanding, giving Berkshire more investment ammunition, but Warren maintained conservative underwriting policies to protect the float's stability. Overall, Chapter 46 captures Warren's growing stature as both a business thinker and a strategic shareholder. It illustrates how his clear analytical framework, steady temperament, and commitment to value investing allowed him to guide companies and investors through complex market environments. Chapter 47 examines Warren Buffett's increasing confidence as a capital allocator in the mid-1970s and the rising momentum behind Berkshire Hathaway's evolution from a struggling textile company into a diversified investment and operating enterprise. This chapter highlights how Warren's disciplined approach to both insurance operations and equity investments positioned Berkshire to expand during a challenging economic period. A key theme in Chapter 47 is Warren's sharpening distinction between operating businesses and marketable securities. He continued to invest heavily in public equities when valuations were attractive, but he also increased his focus on acquiring entire companies that demonstrated strong, durable economics. Warren recognized that full ownership allowed him to control capital allocation internally, retain earnings for reinvestment, and apply Berkshire's resources more strategically. The chapter details Warren's continued reliance on insurance float as the engine for compounding. With National Indemnity and other insurance subsidiaries performing well, float continued to grow, giving Warren investable capital that did not depend on issuing debt or raising equity. However, he emphasized conservative underwriting, insisting that float was only beneficial if the insurance operations did not produce large losses. Another important aspect of Chapter 47 is Warren's selective acquisition strategy. He targeted businesses with predictable earnings, competent management, and strong competitive positions. His philosophy was simple: buy businesses that generate real cash, run efficiently, and do not require constant reinvention. This period marked the early foundation of Berkshire's later portfolio of wholly owned companies. The chapter also touches on Warren's personal routine and work environment. Operating from Omaha continued to give him emotional stability and reduce exposure to Wall Street speculation. His isolation from market noise reinforced his discipline and allowed him to focus on long-term fundamentals. Overall, Chapter 47 captures a stage where Warren Buffett's investment principles, insurance capabilities, disciplined acquisitions, and steady temperament converge, setting the stage for Berkshire's transformation into a major American conglomerate. Chapter 48 focuses on Berkshire Hathaway's transition into owning and operating high-quality, cash-generating businesses, marking a significant step in Warren Buffett's shift from deep value investing toward acquiring companies with long-term economic durability. This chapter highlights Berkshire's acquisition of See's Candies, one of the most important early examples of Warren applying a qualitative approach that prioritized brand strength, pricing power, and customer loyalty. The chapter explains that See's Candies was a family-owned West Coast confectionery company, known for exceptional quality and a deeply loyal customer base. Although the business did not appear statistically cheap in the traditional Graham sense, Warren and Charlie Munger recognized that it possessed strong intangible advantages: brand reputation, regional dominance, and the ability to raise prices without losing customers. These qualities gave See's a consistent and growing stream of earnings. Chapter 48 notes that Warren's partnership with Charlie Munger was instrumental in shifting his thinking. Munger encouraged Warren to look beyond price-to-book ratios and instead evaluate the power of great businesses. See's demonstrated how a company with high return on capital and strong competitive positioning could generate better long-term results than a purely cheap company with weak economics. The acquisition of See's Candies also taught Warren the importance of capital-light businesses, companies that produce significant cash flow without requiring large reinvestment. The strong cash generation from See's provided Berkshire with internal funding to pursue additional investments, helping accelerate Berkshire's growth. The chapter further emphasizes Warren's evolving philosophy on intrinsic value. He increasingly viewed value not just as discounted assets, but as the present value of strong future cash flows driven by durable competitive advantages. Overall, Chapter 48 marks a pivotal shift in Warren's mindset, a deeper appreciation for quality, brand strength, and pricing power, laying the foundation for Berkshire's future strategy of acquiring great businesses at fair prices. Chapter 49 focuses on the strengthening partnership between Warren Buffett and Charlie Munger, and how their combined perspectives begin shaping Berkshire Hathaway's long-term investment philosophy. This chapter highlights a pivotal intellectual shift, the transition from traditional Graham-style deep value investing toward acquiring high-quality businesses with strong competitive advantages. By this point, Warren has already seen the success of See's Candies, and Chapter 49 shows how that experience continues influencing his strategic thinking. Charlie Munger consistently pushed Warren to look beyond statistical cheapness and consider the economic engines behind superior businesses. He emphasized that a great company with durable pricing power and strong customer loyalty, could outperform a cheap company over time, even if the initial purchase price was higher. The chapter explains how Warren and Charlie began discussing frameworks for identifying great businesses using factors such as return on equity, low capital requirements, managerial talent, and brand strength. This approach deepened their shared philosophy of buying companies that could compound earnings internally without needing heavy reinvestment. Chapter 49 also examines Warren's growing confidence in using Berkshire as a long-term holding vehicle rather than merely an investment platform. He continued allocating capital toward companies with predictable, stable economics and avoided emerging industries he could not clearly understand. This discipline, combined with the shift toward higher quality companies, solidified Berkshire's emerging identity as a diversified conglomerate built on rational capital allocation. Another key point in the chapter is Warren and Charlie's shared belief in patience as a competitive advantage. They preferred to wait for rare, high-certainty opportunities rather than constantly search for numerous smaller positions. This mindset reinforced the idea that investing success depends as much on selectivity and temperament as on analytical skill. Overall, Chapter 49 marks a major strengthening of the Buffett-Munger investment model, a blend of value, principles, business quality assessment, disciplined capital allocation, and long-term compounding. Chapter 50 focuses on Berkshire Hathaway's growing expansion during the late 1970s and the strengthening of its investment engine through a combination of disciplined insurance operations, high-return subsidiaries, and increasingly strategic capital allocation decisions by Warren Buffett. This chapter highlights how Berkshire began to evolve into a structured conglomerate rather than a collection of opportunistic investments. A key theme in Chapter 50 is Warren's continued emphasis on deploying insurance float into high-quality assets. With multiple insurance entities now under Berkshire's umbrella, float grew steadily, giving Warren a compounding source of investment capital. As long as underwriting remained profitable or close to break-even, float acted as a powerful financial tool that allowed Berkshire to buy businesses without incurring debt-like obligations. The chapter explains that Warren applied this expanding capital base toward acquiring companies with strong cash flow and durable economics, rather than relying solely on public market securities. Warren broadened Berkshire's holdings in operating companies, particularly those with stable demand, simple business models, and limited need for large reinvestment. These acquisitions strengthened Berkshire's internal earnings engine and diversified its revenue streams. Another important point in Chapter 50 is Warren's maturing partnership with Charlie Munger. Charlie continued guiding Warren toward companies with long-term competitive advantages, businesses capable of generating strong returns even in challenging economic conditions. Their philosophical alignment solidified Berkshire's strategic direction. Focus on business quality first, valuation second, and avoid situations requiring constant restructuring or aggressive intervention. The chapter also highlights Warren's increasing ability to evaluate management talent. He sought leaders who were honest, rational, and committed to running their businesses independently. Berkshire's decentralized structure, allowing subsidiaries to operate autonomously, became one of its defining competitive strengths. Overall, Chapter 50 marks the point where Berkshire's identity as a multi-business, long-term compounding machine becomes firmly established. Warren's disciplined use of float, selective acquisitions, and reliance on exceptional managers sets the stage for Berkshire's rapid expansion. In the decades that follow, Chapter 51 focuses on Berkshire Hathaway's rapid strengthening during the early 1980s, driven by Warren Buffett's disciplined use of insurance float, expansion into high-quality operating companies, and increasingly sophisticated capital allocation strategy. This chapter marks the period when Berkshire transitions from a promising investment vehicle into a structurally advantaged conglomerate with long-term momentum. A central theme in Chapter 51 is the growing importance of GEICO to Warren's overall investment philosophy. Although Berkshire did not yet own GEICO outright, Warren's earlier investment experience with the company and its near collapse during the 1970s had a deep influence on him. Warren admired GEICO's business model underwriting discipline, and direct-to-consumer approach, seeing it as a textbook example of a low-cost operator with structural advantages. GICO's recovery reinforced Warren's belief that great businesses, managed intelligently, can regain strength even after severe setbacks. The chapter also highlights Berkshire's continued expansion into consumer-focused companies with strong brands, predictable cash flow, and loyal customer bases. Warren increasingly favored businesses with durable advantages, recognizing that their long-term economics provided a more reliable compounding engine than traditional deep value situations. Additionally, Chapter 51 illustrates Warren's growing ability to allocate capital across a diversified set of subsidiaries, with See's Candies, the insurance companies, and other operating businesses generating steady earnings. Warren now had multiple internal sources of capital to reinvest. This allowed Berkshire to reduce reliance on market timing and instead accumulate high-quality businesses when opportunities appeared. The chapter also notes an important behavioral point: Warren's patience. Even with expanding capital, he refused to invest simply because money was available. He maintained strict criteria, reinforcing the idea that discipline, not creativity or speculation, was Berkshire's greatest asset. Overall, Chapter 51 captures the consolidation of Berkshire's long-term strategic advantages: strong insurance float, growing earnings power, and the disciplined acquisition of durable, high-return businesses. Chapter 50 focuses on Warren Buffett's expanding stature as a major figure in American business. By the early 1980s, this chapter highlights the increasing influence Warren has through Berkshire Hathaway, not just as an investor, but as a strategic partner sought out by CEOs who value long-term stability, rational analysis, and managerial independence. A central theme in Chapter 52 is Warren's deepening understanding of managerial quality as a key driver of business success. By this point, he had interacted with exceptional executives such as Tom Murphy, Katharine Graham, and others whose leadership styles shaped his definition of great management: honest, rational, and skilled at allocating capital. Warren believed that even a superior business could be damaged by poor management, while average businesses could be significantly improved by strong leadership. This chapter also highlights Warren's increasingly selective approach toward acquisitions. With Berkshire's capital base expanding rapidly through retained earnings and insurance float, Warren had more resources than ever, but he refused to compromise his standards. He waited for opportunities where the economics, management, and price aligned. This selectivity reinforced Berkshire's reputation as a disciplined, long-term owner. Another key point is Warren's expanding network within American business circles. CEOs now actively approached him when considering mergers, restructurings, or sales of their companies. Many viewed Berkshire as an ideal home for their businesses because Warren offered something rare: long-term ownership without interference. This preferred buyer status gave Berkshire access to opportunities unavailable to typical investors. The chapter also notes Warren's growing role as an informal educator. His communication style, clear, rational, and grounded in intrinsic value, made him a sought-after speaker at business schools and conferences. He continued emphasizing core principles: patience, discipline, margin of safety, and understanding one's circle of competence. Overall, Chapter 50 captures Warren's transition from a highly successful investor into a nationally influential business leader, strengthening Berkshire's reputation as a premier long-term owner of exceptional companies. Chapter 53 covers Warren Buffett's expanding role as a major economic thinker during the early and mid-1980s, specifically through his involvement with Salomon Brothers and his deepening understanding of the financial markets beyond traditional value investing. This chapter highlights how Warren's analytical discipline and reputation for integrity positioned him to influence one of Wall Street's most powerful institutions. Even though he had long operated far outside the Wall Street environment, the chapter explains that Berkshire Hathaway acquired a significant stake in Salomon Inc., one of the leading investment banks of the era. Warren saw Salomon as a strategically important company with strong capabilities in bond trading, government securities, and investment banking. While Salomon was not a typical Buffett-style business, complex, capital-intensive, and exposed to market cycles, Warren believed its intrinsic value was higher than the market recognized. Chapter 53 emphasizes Warren's respect for CEO John Gutfreund, whose strong competitive instincts and influence in financial markets made him a dominant figure on Wall Street. At the same time, Warren recognized that Salomon's culture was aggressive and fast-paced, contrasting sharply with Berkshire's decentralization and stability. This exposure broadened Warren's understanding of financial risk, incentive structures, and the importance of culture in large organizations. Another key theme is Warren's growing engagement in public economic discussions. His success managing Berkshire's capital and the scale of his investments led business leaders, policymakers, and journalists to seek his perspective on interest rates, inflation, and market dynamics. Even though Warren avoided making predictions, his clear explanations of long-term value, risk, and discipline elevated his national influence. Chapter 53 also underscores Warren's continued commitment to Berkshire's foundational principles. Despite being involved with a large Wall Street institution, he maintained a long-term focus, avoided speculative behavior, and prioritized ethical conduct. Overall, Chapter 53 shows Warren stepping further into the world of high finance, gaining exposure to complex markets while continuing to rely on rational analysis and conservative decision-making. Chapter 54 examines the increasingly complex relationship between Warren Buffett and Salomon Brothers as Berkshire Hathaway deepens its investment in the firm. This chapter highlights the cultural and structural contrasts between Salomon's aggressive Wall Street environment and Warren's disciplined, principle-driven approach to business. The chapter explains that by the mid-1980s, Salomon was experiencing significant internal tension, intense competition, high compensation structures, and a culture built around risk-taking created instability within the firm. While Warren believed Salomon possessed strong economic potential, especially in fixed-income trading, he also saw warning signs: excessive leverage, internal rivalries, and incentive systems that encouraged short-term behavior rather than long-term stability. Warren's role remained that of an investor rather than an operator, but he gradually became more involved in governance discussions. He observed that Salomon's success depended heavily on individual star traders, whose performance could swing results dramatically. This dependence on talent rather than systems contrasted sharply with Berkshire's model, which relied on stable businesses, decentralized management, and conservative financial practices. Chapter 54 also highlights Warren's ongoing respect for CEO John Gutfreund. Even as he recognized the firm's structural vulnerabilities, Warren admired Gutfreund's intelligence and market insight, but understood that Salomon's culture made it difficult to enforce the kind of disciplined behavior Warren valued. At the same time, Warren's increasing exposure to financial markets through Salomon broadened his understanding of systemic risk, particularly in bond trading and government securities markets. This experience later influenced his thinking on leverage, derivatives, and financial regulation. The chapter further emphasizes Warren's continued commitment to Berkshire's foundational principles. Despite being connected to a high-pressure Wall Street institution, he did not compromise on conservative capital allocation, ethical conduct, or intrinsic value-based decision-making. Overall, Chapter 54 shows Warren navigating the tension between Berkshire's long-term philosophy and the short-term, high-risk culture of Salomon, an early signal of the challenges that would soon escalate. Chapter 55 focuses on the growing internal turmoil at Salomon Brothers, as conflict among senior executives intensifies and the firm's risk-taking culture becomes increasingly unstable. This chapter highlights the widening gap between the values Warren Buffett believed essential for long-term business health: discipline, integrity, and rational decision-making, and the aggressive, competitive environment that characterized Salomon's leadership. By this point, Warren had a large financial stake in Salomon and a close working relationship with CEO John Gutfreund. However, Warren began observing power struggles inside the firm, particularly between Gutfreund and subordinate executives such as John Meriwether, who oversaw the highly profitable arbitrage group. Their internal rivalry reflected deeper issues, compensation disputes, political maneuvering, and a culture that rewarded short-term performance without sufficient regard for firm-wide risk management. The chapter explains that the arbitrage division, while enormously profitable, operated with significant leverage and complex trading strategies. Warren recognized the dangers inherent in a system where traders could generate massive profits or catastrophic losses on positions that senior leadership did not always fully understand. Although Warren admired Meriwether's intelligence and capability, he saw that the incentives driving Salomon's culture encouraged behavior that clashed with his own conservative, margin of safety mindset. Chapter 55 also highlights Warren's growing concern about Salomon's internal controls. He sensed that the firm lacked the structural oversight necessary to manage its exposure, especially in government securities markets. This concern was not yet a crisis, but it marked the early recognition that Salomon's culture could eventually lead to regulatory or financial problems. Despite these issues, Warren continued to support Gutfreund while emphasizing the importance of ethical behavior and disciplined risk management. His involvement remained advisory, but he monitored developments closely. Overall, Chapter 55 captures the escalation of cultural, managerial, and risk management tensions inside Salomon, setting the stage for the major scandal that would soon thrust Warren into direct leadership during one of the firm's most critical crises. Chapter 56 details the beginning of the Salomon Brothers treasury bid scandal, a turning point in Warren Buffett's involvement with the firm, and one of the most serious corporate crises he had ever encountered. While Warren was not directly managing Salomon, his role as a major shareholder placed him at the center of unfolding events that threatened both the firm's survival and Berkshire Hathaway's investment. The chapter explains that the crisis originated when Paul Moser, a senior trader in Salomon's government bond department, repeatedly violated treasury bidding rules, submitting bids under customers' names without authorization to circumvent bidding limits. These actions artificially boosted Salomon's market position and profits, but exposed the firm to severe regulatory consequences once discovered. Initially, Moser and others attempted to conceal the violations from senior management. When the issue finally reached Salomon's leadership, the internal response was slow and insufficiently transparent. Warren later viewed this delay as one of the firm's most damaging missteps. In Warren's philosophy, ethical violations must be addressed immediately, openly, and decisively, principles that Salomon's management failed to apply. Chapter 56 emphasizes that when the U.S. Treasury and regulators learned of the violations, they considered imposing sanctions that could effectively shut down Salomon's trading operations. Such an outcome would have pushed the firm toward insolvency. Warren understood the gravity immediately. The risk was not just reputational but existential. As the crisis escalated, Warren stepped in more directly than ever before. His reputation for integrity, conservative risk management, and clear communication positioned him as the only figure capable of restoring credibility with regulators, investors, and the public. This marked the beginning of his transition from passive board member to emergency leader. Overall, Chapter 56 sets the stage for Warren's most intense corporate rescue effort. It highlights the cultural failures within Salomon, the fragility of firms driven by aggressive incentives, and Warren's readiness to intervene when ethical principles and financial stability were at stake. Chapter 57 covers the escalation of the Salomon Brothers crisis, as Warren Buffett steps into a direct leadership role to stabilize the firm and preserve its ability to operate. This chapter highlights Warren's crisis management strategy, emphasizing integrity, transparency, and decisive action in a situation where regulatory consequences threatened the firm's survival. The chapter begins with the rapid deterioration of Salomon's standing. After the Treasury bid violations became public, the U.S. Treasury considered banning Salomon from participating in future Treasury auctions, a penalty that would effectively destroy the firm. Warren recognized immediately that the only path forward required restoring trust with regulators. He insisted on complete honesty and full cooperation, setting a tone that contrasted sharply with the behavior that caused the crisis. Warren assumed the role of interim chairman of Salomon Brothers. Despite having no background in bond trading or investment banking operations, his priority was not technical expertise, but leadership grounded in ethical clarity. He moved quickly to remove individuals responsible for misconduct, strengthen internal controls, and stabilize employee morale. Chapter 57 highlights Warren's crucial testimony before Congress. His clear, direct, and humble communication style, acknowledging wrongdoing, taking responsibility, and pledging corrective action, played a central role in convincing regulators that Salomon was worth saving. This public appearance became one of the defining moments of Warren's career, cementing his reputation as a principled business leader capable of navigating high-stakes crises. The chapter also describes how Warren balanced the crisis with his obligations at Berkshire Hathaway. Although the situation demanded significant time and energy, he remained disciplined in separating emotional reactions from rational decision-making. Overall, Chapter 57 illustrates Warren Buffett's ability to lead under extreme pressure. By applying his core values, honesty, accountability, and long-term thinking, he prevented a collapse that would have been catastrophic for Salomon, Berkshire, and financial markets more broadly. Chapter 58 focuses on the aftermath of the Salomon Brothers scandal and Warren Buffett's continuing efforts to stabilize the firm while protecting Berkshire Hathaway's investment. This chapter highlights Warren's methodical approach to crisis resolution, emphasizing cultural repair, governance restructuring, and the restoration of trust within both the financial community and government agencies. The chapter explains that, although Warren's congressional testimony helped avert an immediate shutdown, Salomon remained under intense scrutiny from the Treasury, the Federal Reserve, and the SEC. The firm needed a multi-layered rehabilitation plan. Warren prioritized full transparency with regulators, insisting that Salomon adopt practices consistent with Berkshire's standards: honesty, conservative risk controls, and alignment between incentives and long-term stability. A major theme in Chapter 58 is Warren's focus on cultural transformation. He recognized that the root of Salomon's problems was not one trader's misconduct, but a system that rewarded aggressive behavior, tolerated ethical gray areas, and lacked strong internal oversight. Warren enforced strict behavioral standards, communicated expectations clearly, and set a tone that placed integrity above profit. This shift was essential to preventing future violations and rebuilding the firm's reputation. The chapter also highlights Warren's approach to leadership during the transition. Although he did not seek operational control, he played a hands-on role in selecting new executives and stabilizing the organization. He supported restructuring efforts, helped reestablish relationships with clients, and worked directly with regulators to ensure compliance improvements were implemented. At the same time, Warren continued managing Berkshire Hathaway with discipline. He reminded shareholders that Salomon, although significant, represented only part of Berkshire's overall portfolio. His clear communication helped maintain investor confidence during a period when uncertainty around Salomon could have spilled over into Berkshire. Overall, Chapter 58 underscores Warren Buffett's ability to guide a major financial institution through a complex recovery effort. His emphasis on integrity, transparency, and long-term thinking became the foundation for Salomon's survival and gradual return to stability. Chapter 59 examines the final phase of the Salomon crisis and Warren Buffett's gradual withdrawal from the firm as it returned to stability. This chapter highlights the long-term implications of Warren's leadership during the scandal and how the experience shaped his views on governance, culture, and risk management. The chapter explains that although Salomon avoided collapse, the firm remained under strict regulatory supervision and operational constraints. Its profitability suffered because of fines, legal expenses, and internal restructuring. Warren understood that the organization needed long-term leadership, with deep expertise in financial markets, something he never intended to provide on a permanent basis. His role was to stabilize the firm ethically, regain regulatory trust, and hand responsibility to a capable management team. A central theme in Chapter 59 is Warren's emphasis on restoring credibility. He worked closely with regulators, clients, and employees to ensure Salomon demonstrated consistent compliance and cultural reform. Warren reinforced the message that the firm's future depended on conservative behavior, transparent reporting, and a rejection of the aggressive incentive systems that created the original problems. The chapter also discusses Warren's decision to transition leadership to Derek Morgan, who was appointed CEO to guide the firm forward. Warren supported Morgan's mandate to rebuild operational discipline and strengthen risk controls. This transition allowed Warren to reduce his day-to-day involvement and return focus to Berkshire Hathaway. Chapter 59 highlights that the crisis significantly influenced Warren's thinking. He came away with a deeper understanding of systemic risk, the dangers of leverage, and the importance of ethical leadership in large organizations. The episode reinforced his long-standing belief that culture, not strategy, is what determines whether a business survives under pressure. Despite the turmoil, Warren's credibility emerged stronger. His integrity during the crisis enhanced Berkshire's reputation and demonstrated his ability to lead during uncertainty. Overall, Chapter 59 closes the Salomon chapter by showing Warren guiding the firm back to stability, while solidifying lessons that shaped his future approach to risk, leadership, and investment. Chapter 60 marks Warren Buffett's return to focusing fully on Berkshire Hathaway. After stepping back from his crisis management role at Salomon Brothers, this chapter highlights how Warren redirects his attention toward long-term investing, strategic acquisitions, and rebuilding momentum after years absorbed by Salomon's problems. It also illustrates how the lessons from the scandal sharpened his thinking about risk, culture, and capital allocation. The chapter explains that once the Salomon situation stabilized, Warren resumed evaluating opportunities for Berkshire with renewed clarity. He sought businesses with consistent earnings, strong management, and minimal need for oversight. After the cultural dysfunction he witnessed at Salomon, Warren placed even greater emphasis on finding companies with trustworthy, competent leaders. He wanted Berkshire to own firms that required little intervention and operated with rational, ethical decision-making. Chapter 60 also highlights the strengthening of Berkshire's decentralized model. Subsidiary managers were allowed broad autonomy as long as they delivered honest reporting and disciplined capital use. Warren doubled down on this structure because it ensured that Berkshire would not replicate the oversight failures he experienced at Salomon. The crisis reinforced his belief that the right people, culture, and incentives mattered more than complex systems. Financially, Berkshire was in a strong position. Insurance float continued to grow, and Warren had a large, stable base of assets available for deployment. He emphasized patience, waiting for rare opportunities, where Berkshire could buy outstanding companies at reasonable prices. Warren's investment philosophy remained unchanged: avoid speculation, maintain discipline, and rely on intrinsic value analysis. The chapter also notes Warren's renewed focus on long-term compounding. After years of dealing with crisis management, he returned to the investing environment where he excelled, evaluating businesses, communicating clearly with shareholders, and building Berkshire into a durable, multi-decade enterprise. Overall, Chapter 60 captures Warren Buffett's transition from crisis leader back to long-term investor, equipped with sharper insights and an even stronger commitment to disciplined, ethical business management. Chapter 61 focuses on Warren Buffett's renewed momentum at Berkshire Hathaway in the years following the Salomon crisis, highlighting how he leveraged the company's growing financial strength to pursue larger, more strategic acquisitions. This chapter illustrates Berkshire's transition from a successful holding company into a major force, capable of buying entire businesses of national significance. The chapter explains that by the early 1990s, Berkshire had accumulated a substantial base of insurance float, compounded earnings, and consistent operating income from subsidiaries such as See's Candies, Nebraska Furniture Mart, and the insurance operations. This financial firepower enabled Warren to target companies of greater scale businesses that aligned with his long-term philosophy of quality, predictability, and durable competitive advantage. A major emphasis in Chapter 61 is Warren's acquisition of Dexter Shoe Company, a deal that later became one of his most significant investment mistakes. At the time, Dexter appeared to be a strong, well-managed business with a respected brand and healthy profitability. Warren believed it met his criteria for durable competitive advantage. He paid for Dexter not with cash, but with Berkshire stock, an important detail that magnified the long-term impact of the mistake. The chapter highlights that the competitive environment for American shoe manufacturers shifted rapidly due to foreign competition. Dexter's advantage eroded far more quickly than Warren anticipated, revealing weaknesses in his assessment of the company's long-term economics. Warren openly acknowledged the error, labeling it one of the most costly in Berkshire's history because he used Berkshire shares, effectively giving away equity that would later multiply in value. This chapter reinforces Warren's philosophy of intellectual honesty. He treated the Dexter mistake as a critical learning experience, strengthening his commitment to analyzing long-term competitive durability before making acquisition decisions. Overall, Chapter 61 captures Warren's expanding ambitions, Berkshire's increasing financial strength, and the importance of humility and self-evaluation in long-term investing. Chapter 62 examines Warren Buffett's continued expansion of Berkshire Hathaway during the 1990s, highlighting how Berkshire matured into a large-scale conglomerate, with increasing visibility in the U.S. economy. This chapter focuses on Warren's evolving leadership role, the growth of Berkshire's subsidiaries, and his deepening partnership with Charlie Munger in shaping long-term strategic decisions. A key theme in Chapter 62 is Berkshire's growing operational complexity. By this time, the company controlled a wide range of businesses: insurance, retail, manufacturing, and consumer brands, each generating consistent cash flow. Warren managed Berkshire with a decentralized structure, relying heavily on subsidiary managers to run operations independently. This model reflected his belief that the best results come from talented leaders, empowered to make decisions without corporate bureaucracy. The chapter also highlights Warren's increasing investment in capital-intensive businesses that possessed strong competitive moats. One example discussed is Berkshire's purchase of large utility and energy assets through Mid-American Energy, later Berkshire Hathaway Energy. These businesses required significant regulatory oversight and long-term capital commitments, yet they offered stable earnings and durable economic characteristics, exactly the type of predictability Warren valued. Another important theme in Chapter 62 is Warren's shifting public image. As Berkshire grew, so did Warren's visibility. Investors, analysts, and journalists began treating Berkshire's annual meeting as a major financial event, turning it into what would later be called the Woodstock of capitalism. Warren embraced these interactions, using them to reinforce core principles like rationality, integrity, and long-term thinking. The chapter also emphasizes Warren's reliance on Charlie Munger's broader intellectual influence. Munger pushed Warren to think beyond traditional value metrics and evaluate companies based on business quality, competitive advantage, and the power of long-term compounding. Overall, Chapter 62 captures Berkshire's evolution into a diversified, stable, and strategically managed conglomerate. It highlights Warren's disciplined leadership, expanding investment scope, and the continued refinement of the Buffett-Munger investment philosophy. Chapter 63 focuses on Warren Buffett's expanding public presence and the increasing cultural relevance of Berkshire Hathaway during the 1990s. As Warren's reputation grew, he transitioned from being viewed primarily as a successful investor to becoming a widely recognized national figure whose opinions influenced markets, corporate governance, and public policy debates. The chapter explains that Berkshire's annual meetings evolved into major financial gatherings, attracting thousands of attendees from individual investors to institutional analysts who wanted to hear Warren and Charlie Munger discuss investing philosophy, business strategy, and economic principles. Their candid, plain-spoken style resonated across the financial community, turning the events into a uniquely educational forum. This period planted the seeds for Warren's later identity as one of the world's most respected business communicators. A central theme in Chapter 63 is Warren's increasing visibility in the media. Journalists frequently sought his perspective on market behavior, capital allocation, and corporate responsibility. Despite his introverted nature, Warren understood the value of clear communication and used these opportunities to reinforce key principles: long-term thinking, avoidance of speculation, and the importance of sound economic fundamentals. The chapter also highlights Warren's expanding philanthropic relationships. Although he had not yet made his historic pledge to give away the majority of his wealth, Warren began increasing his charitable involvement, influenced significantly by Susie's long-standing dedication to community work. This period marks the early stages of Warren's gradual shift toward integrating philanthropy into his long-term legacy. Operationally, Berkshire continued strengthening its foundation. Warren allocated capital into businesses with durable competitive advantages, emphasizing quality over quantity. He maintained strict discipline in valuation and risk, even as Berkshire's scale made finding suitable investments more challenging. Overall, Chapter 63 captures Warren's transition into a public, intellectual, and corporate elder statesman, blending investment leadership, transparent communication, and growing philanthropic awareness, all while reinforcing the core principles that define Berkshire Hathaway. Chapter 64 examines Warren Buffett's life during the late 1990s, a period shaped by two major forces operating in parallel: Berkshire Hathaway's accelerating growth and the deepening personal challenges faced by Warren and Susie Buffett. This chapter highlights how Warren navigated an expanding business empire while confronting emotional strain within his marriage, especially as Susie's health declined. Professionally, Warren continued allocating Berkshire's growing capital into high-quality businesses, with substantial insurance float and strong earnings from subsidiaries. Berkshire entered a scale that few conglomerates in the world could match. Warren and Charlie Munger focused on large, predictable businesses with durable moats, further solidifying Berkshire's identity as a long-term compounding machine. Warren remained disciplined, refusing to follow market speculation despite the late 1990s tech boom. His refusal to invest in internet stocks, despite massive public pressure, reinforced his reputation for rationality and adherence to circle of competence thinking. However, Chapter 64 devotes significant attention to Warren's personal life. Susie's gradual decline in health deeply affected him. Although they lived apart, Susie remained the emotional foundation of Warren's life. Her declining well-being created emotional instability for Warren, revealing his continued dependence on her for support, comfort, and personal grounding. The chapter emphasizes that Warren's success did not erase his emotional vulnerabilities. On the contrary, it underscored how essential Susie had always been to his stability. The chapter also touches on the increasingly important role of Astrid Manx, who supported Warren in daily life as Susie's ability to do so diminished. Yet the arrangement remained anchored in mutual respect and the unique family structure the three had developed over decades. Overall, Chapter 64 captures a dual reality. Berkshire was reaching new heights as an investment powerhouse, while Warren privately faced the emotional challenges of Susie's declining health. It illustrates the intersection of professional momentum and personal vulnerability in Warren Buffett's life. Part 4, The Oracle Emerges. Part 4 captures Warren Buffett's transformation from a talented regional investor into a nationally recognized leader in American business. This section covers the rise of Berkshire Hathaway as Warren's permanent investment platform, the strategic use of insurance float, and Warren's breakthrough shift from pure value investing to owning high-quality businesses with durable competitive advantages. His partnerships dissolved, but Berkshire became the vehicle through which his capital compounding accelerated. Warren bought companies like See's Candies and the Washington Post Company Investments that defined his long-term philosophy: buy great businesses at fair prices, trust strong managers, and avoid speculation. This part also highlights Warren's evolving public identity. As markets struggled in the 1970s and 1980s, Warren's clarity, patience, and discipline earned him attention from CEOs, journalists, and students. He became a trusted voice on market behavior and capital allocation, even as he continued operating from Omaha, far from Wall Street noise. Overall, Part 4 shows the birth of the Oracle of Omaha, supported by strategic evolution, disciplined investing, and the early structure of a unique conglomerate. Part 5. The Crisis Years. Part 5 centers on one of the most dramatic chapters in Warren's career, the Salomon Brothers scandal. As a major shareholder, Warren was forced into emergency leadership when traders violated Treasury auction rules, and senior management failed to respond appropriately. This section analyzes Warren in crisis mode: transparent, ethical, and decisive. His congressional testimony helped prevent a ban that would have bankrupted the firm, proving that character can be a business asset. Warren restructured management, communicated openly with regulators, and stabilized the company despite not being a Wall Street insider. Part V exposes a sharp contrast between Berkshire's culture and Salomon's high-risk environment. It reinforced Warren's belief that incentives, governance, and ethics determine whether a business can survive extreme pressure. These years taught him some of his most important lessons about risk, leverage, and corporate culture, insights he would apply for decades to come. Part 6. Legacy, Scale, and Personal Loss. Part VI highlights Berkshire's emergence as a massive global conglomerate and the personal challenges Warren faced during the company's peak expansion. Berkshire acquired larger businesses, expanded into utilities and energy, and refined its decentralized structure. The Buffett-Munger partnership matured into a unified investment philosophy built on quality, durability, and long-term compounding. At the same time, Warren faced emotional strain as Susie's health declined. Although they lived separately, she remained his most important emotional anchor. Her declining condition revealed Warren's dependence on her support, even as his public reputation soared. Astrid Manx continued supporting Warren daily, preserving the unique family arrangement that had defined his personal life. Part 6 presents a balanced image: Warren Buffett as a global financial figure and Warren Buffett as a vulnerable individual, facing personal loss while stewarding one of the world's most successful companies. If you're serious about money, real money, long-term wealth, and learning directly from the world's greatest investor, then stay with this channel. Hit subscribe, drop a like, and tell me in the comments which Buffett lesson hit you the hardest. We've only scratched the surface of the snowball. More deep dive breakdowns are coming: Berkshire strategy, Buffett psychology, and investment principles you can actually use. Follow for the next chapter in building your financial mindset.